Have you ever wondered how expert traders predict the movements of the stock market, cryptocurrency, or Forex? How do they know when to buy or sell? The secret lies in technical analysis, a powerful tool that helps traders make informed decisions by analyzing market data. In this video, we're going to dive into the basics of technical analysis and explain how it can help you navigate the complexities of the financial markets. Whether you're looking to understand the fundamental principles or you're just starting your trading journey, you've come to the right place. At its core, technical analysis is the study of historical market data, primarily price and volume, to forecast future price movements. It's a method of analyzing financial markets based on chart patterns, indicators, and price action. Unlike fundamental analysis, which focuses on a company's financial health or economic conditions, technical analysis is purely concerned with market sentiment and price trends. Traders and investors use technical analysis to identify entry and exit points. By understanding how prices behave over time, they aim to predict future market behavior, which helps them make better decisions on when to buy or sell. The basics of technical analysis. Before we dive deeper, let's go over the key components of technical analysis that every beginner should know. 1. Charts. Charts are the foundation of technical analysis. A chart visually represents the price movements of a financial asset over time. The y-axis indicates the stock price, while the x-axis represents the timescale. A charting tool maps the stock's prices from left to right along the x-axis, with the latest price appearing on the far right side. There are different types of charts, but the most common are line charts, bar charts, and candlestick charts. Before diving into chart analysis, it's essential to remember a key point. In technical analysis, we primarily deal with 4 price levels over a given time period, which could be a day, a week, an hour, or any other interval. These price levels are open, close, high, and the low. These values provide the foundation for understanding market behavior and identifying patterns. Line chart. A line chart is a simple and straightforward representation that connects closing prices over a specific period of time. One of its key advantages is its simplicity, which results in a clutter-free chart. This makes it particularly useful for identifying general price trends and patterns, without being overwhelmed by excessive details. However, it's important to note that line charts only focus on closing prices, leaving out other valuable data such as opening, high, and low prices. While this minimalism is helpful for clarity, it may not provide the full picture needed for more detailed technical analysis. Bar chart. A bar chart is a key tool in technical analysis, used to visualize price movements of a financial asset over a specific period. Each bar on the chart represents a unit of time, such as a 1-minute bar chart, which shows a new price bar for every minute, or a weekly bar chart, which displays a new bar for each week of price movement. Each bar provides 4 critical data points: the opening price, the highest price, the lowest price, and the closing price. The vertical line of the bar indicates the price range, high to low, while small horizontal ticks to the left and right represent the opening and closing prices, respectively. Colors are often used in bar charts to provide additional visual clarity. Typically, a green or blue bar indicates that the closing price is higher than the opening price, signaling an upward movement. In contrast, a red bar represents a downward movement, where the closing price is lower than the opening price. These colors help traders quickly interpret market trends and sentiment at a glance. Candlestick charts. The 4 key elements of a candlestick are the open, close, high and low prices for a given time frame. The candlestick shape changes depending on how these prices, the open, high, low, and close, relate to one another. Each of these components provides insight into the asset's price movements within the chosen time frame. The section between the opening and closing prices is known as the body. The color of the body reflects whether the price movement was bullish or bearish.
When the closing price is higher than the opening price, the body is typically green, indicating a bullish movement. Conversely, when the closing price is lower than the opening, the body is usually red, indicating a bearish movement. While colors may vary across platforms, green and red are the most common. The length of the candlestick body provides important insight to traders. A longer body represents a stronger price movement. A long red body suggests intense selling pressure, signifying fear, while a long green body indicates strong buying activity, indicating optimism in the market. Upper and lower shadows. Most candlesticks feature thin lines, often called shadows or wicks. The upper shadow is the line that extends from the top of the candlestick body to the highest price reached during the trading period. In contrast, the lower shadow extends from the bottom of the body to the lowest price reached in that period. The length and position of these shadows offer important clues about market dynamics.
As we mentioned, technical analysis consists of 4 elements. We reviewed the first element, which focuses on charts. Other elements, such as trends, resistance and support levels, and volume, will be covered in future videos. So stay tuned to watch the upcoming videos, and don't forget to like, comment, and subscribe.